Chapter 21, Roth IRA. True or false? Unlike a traditional IRA, a Roth IRA contribution is not restricted by active participation in an employer's retirement plan. Well, the answer to this is true. There are no limits like a traditional IRA related to active participation in employees' retirement plans, so anyone may open a Roth IRA contribution plan. Question 2. An early distribution penalty can be assessed on Roth IRA withdrawals. That is true. Similar to a traditional IRA, there are distribution penalties if Roth IRAs are withdrawn prior to age 59.5, prior to a 5-year holding rule. Question 3. Account holders with more than one Roth IRA can treat them as separate accounts when calculating tax consequences of distributions from any of them. And the answer to that is false. You must treat all Roth IRA accounts together as one account when calculating the tax consequences. Number 4, employers cannot sponsor Roth IRAs for employees as an alternative to employer-sponsored retirement plans. And that is false. They may sponsor Roth IRAs. Question 5. With a Roth IRA, there are no minimum distribution requirements at age 70.5 as they are for traditional IRAs, and that is true. Question 6. A Roth IRA can be rolled over to a traditional IRA. That is false. The opposite, you may roll a traditional IRA into a Roth IRA, and then you must pay taxes on the distributed amount. Question 1. Peter is 55 years old and he decided to establish and contribute to a Roth IRA for the first time this year. What is the minimum number of years Peter must wait before being able to withdraw any accumulated earnings from the Roth IRA tax-free? C. 5 years is the correct answer. Question 2. Andrew established a Roth IRA 5 years ago. When must he begin taking distributions in order to avoid the required minimum distribution penalty? Well, the answer is never. A Roth IRA is never required during life to take a required minimum distribution. Only after death would required minimum distributions be required. However, if the beneficiary is the spouse, then the Roth IRA maintains its tax-free status until that person's death. Question 3. How many times during a year may a Roth IRA be rolled over to another Roth IRA tax-free? The answer is 1, the same as a traditional IRA rolled over. The answer is 1. Question 4. Sandy wants to convert her traditional IRA to a Roth IRA. The current IRA account value is $100,000. If Sandy follows through, how will the conversion be taxed? Well, the answer is B, $100,000 as ordinary income. Whenever a traditional IRA is converted to a Roth IRA, then it generates ordinary income. A tax-free rollover of Roth IRA can be made to, the answer is A, only another Roth IRA. Question 6. If an individual made a contribution to a Roth IRA more than 5 years ago, and remember 5 years is the limit, which of the following permits a tax-free distribution from Roth IRA? A. Distribution is made to help purchase a first home for grandchild of Roth IRA owner. That is correct. That is one of the exceptions. B. Distribution is made to individual short-term disability. The key here is short-term and not permanent, so that is not possible. Item C. Distribution is made after age 59.5. That is correct. D, all of the above is not correct because B is not correct. So the answer is A and C. Question 7. Ways that a Roth IRA differs from a traditional IRA include A. Initial investment earnings can be withdrawn tax-free. That is true in the Roth. It is not true in the traditional, so that is a difference. B. Roth IRA contributions can be made past age 59 and a half. That is true, but that also is true for the traditional. The age is 70 and a half, where you may make to a Roth, but may not to a traditional. C, both IRAs are never subject to minimum distribution rules. No, that's not correct. They are subject to minimum distribution rules at death. Therefore, A, initial investment earnings can be withdrawn tax-free is the correct answer. 5-year holding period begins, A, every time an existing IRA rolls over into a Roth IRA. That is not correct. It has based on when it's opened. When the individual turns 59 and a half, not true. After the first distribution, not true. With the first taxable year for which the account holder has a Roth IRA contribution, that is correct. The 5-year period, holding period begins in that first year a contribution is made. Orville died last year at age 58, leaving $500,000 accumulated in the Roth IRA. Which of the following is true? A. Monies in the Roth IRA must be distributed within a year of Orville's death, either to his estate or beneficiary. B. Distribution from the account can be made over the life of a designated beneficiary if begun within a year of Orville's death. Well, that is correct. C. The initial distribution of Orville's Roth IRA funds to a beneficiary are tax-free, which is true, but subsequent investment returns on amounts distributed are taxable, and that is correct. So the proper answer is E, number B and C. Question 10. George was transferred to Chicago 3 years ago. When he left Detroit, he sold his home and put some of the money in a new Roth IRA. He and his wife have been renting a home for the past 3 years. Recently, the homeowner decided to sell. George is interested in buying the home. George can make a penalty-free withdrawal from his Roth IRA to help complete the purchase. True or false? Well, the answer is false. It's within the 3 years. And the other rule would be he will be able to take a penalty-free withdrawal if it were after 5 years up to $10,000 to complete the purchase. So the answer to this question is false. Question 11. Pause the video while you read the question and restart the video for the answer explanation. The answer to question 11 is E. Both are right because the two investments are actuarially equivalent, but absence of a minimum distribution date and more liberal penalty-free withdrawal options may make the Roth IRA more attractive. The answer is E. Question 12. Quincy Winstar, age 50, has $200,000 in traditional IRAs considering conversion to a Roth IRA in 2016. Quincy earns $125,000 per year and his wife Shauna earns $50,000. They file separate tax returns. As his financial advisor, you tell Quincy, A, he is not eligible for making an IRA conversion. This is not correct. Anyone may make an IRA conversion no matter the income limits. Limits are related to contributions and not conversions. B, he would have to pay income tax on any amounts rolled over from the traditional IRA to the Roth IRA. That is true. He would have to pay a 10% penalty in addition to tax on monies rolled over since he is under age 59 and a half. That is not true. You may roll over a traditional to a Roth at any time. D, he can make a tax-free rollover from a traditional IRA to a Roth IRA. No, that may not be done. E, he can minimize the tax contributions of the rollover by using a series of annual partial conversions rather than one large conversion. And no, that relates to distributions. So the correct answer is B, he would have to pay income tax on the amounts rolled over. I believe that they say A is the answer, but that is not correct because there are no income limits relating to conversions. That only would relate to contributions.